Good morning, this is Dave Toth with an RJO MRT Technical Webcast update on the S&P E-mini, 10-year T-note, and Eurodollar markets for Tuesday, August 24th. You can see here on an intraday chart of the S&P E-mini, the September contract, the market has once again reaffirmed at least the intermediate term downtrend with overnight's break below Friday's 1061.75 low. This comes after another 50% recovery, failed recovery attempt, just like we had last week with versus the preceding 1128 to 1066 decline. The market recovered 50% before relapsing to new lows. On a slightly smaller scale, we had a repeat of that behavior. The 1098.5 break down to 1061.75. The market recovers exactly 50% and then resumes the downtrend. The importance of this is that it defines yesterday's 1080.25. We're going to round up to 1081 as the latest and tightest corrective high. This market is now minimally required to recover above to defer or threaten a larger degree bearish count. In lieu of at least such strength, further and possibly accelerated losses are expected straight away. It's worth keeping in mind that this month's price action comes on the heels of what is only a three-wave and thus, we believe, bear market corrective recovery from July through August that stalled at the 61.8% retrace of the preceding April through July decline from 1216 down to 1002. We think this creates a really good set of factors that are consistent with a much larger degree peaking and reversal threat that exposes new lows below the July low of 1002. On a weekly log scale basis here, you can see our reasons for being concerned about a much larger degree reversal lower, those reasons being the prospectively complete five-wave Elliott wave sequence from the March 09 low at 666 to this year's high at 1216, a confirmed bearish divergence in momentum during that May through July period below the late January low at 1040 that breaks that long-term uptrend, and by virtue of this three-wave 61.8% recovery attempt, failed recovery attempt from July through August, we think that's merely bear market corrective. Ultimately, we think this market has legs to levels potentially significantly below that 1002 low from early July. In sum, a bearish policy remains advised with strength above at least 1081 and preferably 1128 required to defer or threaten this bearish view. Continuing to corroborate the weakness in the equity markets and in the economy, global economy as a whole, is virtually no pressure on interest rates whatsoever. You can see that by virtue of yesterday's and overnight's recovery in the September 10-year market. The market has exposed this latest sell-off attempt as merely a lateral corrective bull flag behavior that's consistent with the broader trend higher and reinforces our recent corrective low at 125.06 as the latest and tightest corrective low in risk parameter. This market is now minimally required to fail below to defer or threaten a broader bullish count. Looking here at a daily chart, you can see the clear and present uptrend that is expected to continue and perhaps even accelerate. On a weekly scale, you can see the market's encroachment on the December all-time high from December 08 of 128.22. But whether the market respects that resistance or fails is going to clearly be a factor that we'll discern by virtue of a confirmed momentum failure below a recent corrective low like 125.06. From a very long-term perspective, it's important to understand the relationship between the 10-year yield and the 2-year yield, and you can see it's coming off a recent extremely wide or extremely steep spread of 281 basis points. As recently as November of 06, that yield curve was actually inverted. And what that means is that there's a ton of yield space here from the current about 200 basis points to even 100 basis points where the 10-year market can continue to come down in rates, up in futures prices relatively unabatedly. In sum, a bullish policy remains advised with weakness below at least 125.06 required to defer or threaten this view, and we don't want to underestimate the extent to which this market can continue and perhaps even accelerate higher from current perceived lofty levels of a 126 handle. And finally, looking at the short end of the curve, the March 2011 Eurodollar market, you can see the dominance of the uptrend as a technical factor, with weakness below 99.44 on a daily basis required to confirm a bearish divergence in momentum needed to arrest a mammoth bull trend such as this. On a short-term intraday basis, you can see recent resistance turn support in the 99.53 area. Minimally, that 99.53 level is the level the market needs to fail below to even expose an interim corrective dip, let alone a reversal lower. In sum, a bullish policy remains advised for the Eurodollar contract, March 11 Eurodollar contract as well, with weakness below at least 99.53 and preferably 99.44 required to defer or threaten that view. Please stay tuned to updates on these and other markets on our RJOMRT.com website, and good luck with today's trading.